has not stopped. In fact, this is the biggest piece of BRICS bullish news that I've heard in the 4 years I've been covering it, and that is that they have the ability to offer this network to non-BRICS nations with the exception of the euro, the pound, and the dollar.
But $10,000, $20,000, $50,000 gold, that credit card gets canceled. The fiat experiment has and is failing. You know, $25,000, $50,000 gold completely breaks confidence in the credit markets and breaks confidence in the currency markets.
And this is just so much like previous bubbles. It really is. We're there this time with Bitcoin. So this is not good news for hodlers and for those who sort of can't really make up their mind whether they should be holding gold or cryptos or whatever.
In today's news recap, silver price seems reluctant below $37. Downside remains limited. Silver holds steady below the $37 mark during the Asian session on Friday and remains within striking distance of over a 2-week high touched the previous day. Meanwhile, the constructive technical setup suggests that the path of least resistance for the white metal remains to the upside. The daily relative strength index remains above 50 and validates the positive outlook for the silver. However, the MACD histogram and the signal line on the daily chart are yet to confirm bullish bias, suggesting that any subsequent move up could stall near the 37.30 to 37.35 region, or the highest level since February 2012 touched earlier this month. Some follow-through buying, however, would set the stage for an extension of a nearly 3-month-old uptrend. On the flip side, the $36.50 to $36.45 area now seems to protect the immediate downside, below which the silver could slide to the $36.15 to $36.10 region. A further decline below the $36 mark could extend towards the $35.50 to $35.40 horizontal zone. The latter should act as a key pivotal point, and a convincing break below would shift the near-term bias back in favor of bearish traders. The white metal might then accelerate the corrective fall towards the next relevant support near the $35 psychological mark. Some follow-through selling below the latter should pave the way for deeper losses and drag the silver price to an intermediate support near the $34.75. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps, and check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
In essence, the Hunt brothers should have, the environment that the Hunt brothers tried to expose and exploit is exactly what you see right now. Far more contracts than bars backing it. And they bought up all the contracts and stood for delivery. They changed the rules. They being the exchange, which is owned by the banks, which will protect themselves. The difference is the LBMA is not an exchange. It's an over-the-counter exchange. There isn't a central clearing authority. It's peer-to-peer in essence. Me versus you, and if it breaks, there's no one there to step in per se unless they get all of the members to do it, whereas on COMEX it's a different thing. It's a different animal. They can just in essence create a force majeure, shut it down, say no more deliveries, or do what they did in London when you saw the nickel problem. They just invalidate everything. We're getting to the point where that will happen, where whether it's outright default, it'll appear the exact same thing, and it will be settled in a manner where you would say, well, this was done to avoid a default. And, you know, I think that if we wait for that moment to happen, you can see that they're doing all they can right now to keep that from happening. We get to that point, yeah, if the COMEX were to default, the entire precious metals complex breaks down. And I think that ultimately where you will see things change is you're beginning to see the development and the maturity of other exchanges in Dubai, in Shanghai. You'll see the BRICS development of the BRICS Metals Exchange. You'll see the Moscow Exchange. These exchanges now in Singapore, these exchanges that are coming up throughout Asia in particular, and the BRICS network, will be more of a cash and carry, reflective of real price settlement. And it's almost like these players are trying to exploit as much as they can through delivery using the Western system until the Western system breaks. And whether it breaks by outright delivery default on one of the two exchanges is debatable. But I think, in essence, whether we get to that point and see it or just realize it was inevitable before they came in and stepped in to protect themselves and changed the rules the way they did under the Hunt brothers, where they said you can be as short as you want, but only long a certain amount, like 1 million contracts or whatever it is. And then anything over that amount, they were forced to sell. And that's what drove the price down. Now that is manipulation of the exchange to protect itself and screwed the Hunt brothers. Well, something like that I would expect would happen before you'd see one of these big banks blow up. But in London, no, I think in London you could see a default by a very large institution and there will be no one in there to step in to rescue. It's a fair question. I can't really answer it definitively, but simply to say it seems like we're getting closer and closer to that moment.
Now, Bill Holter shares his view on what's next for gold and silver prices and how you should prepare for it.
Where they're going to go to next. Yeah. And I've maintained that during good times, or quote, perceived good times, they won't be able to bring a central bank digital currency anywhere or worldwide. They have to do it during massive stress. So they will allow these markets to collapse. The great taking will take hold. People are going to lose, they're going to lose their assets. Yes. You know, whether it be a bank, a broker, insurance company, whatever. And at that point is when they will try to introduce the CBDCs, because the public will be begging for help. Yep. So I think that's 100%. The next move is CBDCs, before we get into really crazy stuff. You know, capitalism was the root of all evil, blah, blah, blah. You know, we got to have socialism. People who have bought gold and silver they're going to look like villains. Right. It's going to be blamed on them. And I would say anybody who bought gold or silver over the last 5, 10, 20 years or longer even, they did so to protect themselves and to protect their families. Yeah. The problem is the math is so bad, and the math now is so obvious that you've got more and more and more investors worldwide that are coming to the same conclusion, coming to the same answer. And collectively, they're creating a supply and demand deficit. The demand is increasing. Mine supply is not increasing any longer. There's not been any major discoveries or finds in the last, since 2011, 12, 13, so over 10 years. So the buyers or the holders of gold are going to be villainized. They will be called victims, or not victims, villains, available for sale at these prices. Yeah. Yeah. I mean, the old story goes, oh, well, there's just not enough gold in the world to create a gold standard for all the currencies. Well, just at the price. Of course there is. If you had 1 ounce and if it was priced correctly, there'd be enough gold.
In today's news recap, Citi says gold crashes to 2,500, while JP Morgan sees 4,000. Here's who's right. One of these banks is about to be spectacularly wrong. Citigroup sees gold crashing 25%, while JP Morgan predicts a 20% surge. This isn't just a difference of opinion, but a fundamental disagreement about the future of global finance. A $1,500 per ounce divergence that will cost investors billions. The Chinese insurance paradox. Both banks acknowledge that China recently authorized 10 major insurance companies to allocate up to 1% of their assets to gold. Yet somehow they draw completely opposite conclusions from this. Citigroup frames this development as temporary artificial support. In their view, the Chinese insurance buying merely masks underlying weakness in Western investment demand and delays an inevitable price correction. They see the $3,100 to $3,500 range as a distribution zone, where long-term holders will gradually exit positions before gold eventually collapses below $2,500. As for JP Morgan, it interprets the Chinese move as the beginning of a broader institutional shift. The mathematical paradox Citigroup's bearish mathematics assume that Chinese insurance demand will be overwhelmed by ETF outflows, resulting in net negative demand by 2026. JP Morgan's calculations project demand of approximately 2,800 tons, supporting their bullish trajectory toward $4,000. The macro paradox. This divergence reflects incompatible assumptions about the global economy's direction. Citigroup's thesis is based on what they term the Trump growth put, a belief that pro-growth policies will restore economic confidence, reduce recession fears, and trigger a rotation from gold back to risk assets. JP Morgan sees structural forces that transcend political cycles. The bank views tariff-driven risks, potential stagflation, the accelerating de-dollarization, and persistent geopolitical tensions as fundamental drivers that will sustain gold demand regardless of short-term market optimism. The headlines: paradox. The bank's chosen headlines reveal their core convictions. Citigroup selected gold below 3,000, despite actually predicting consolidation around 3,300 for most of 2025. This bearish framing shapes client behavior toward distribution rather than accumulation. JP Morgan's gold to $4,000 headline anchors bullish expectations and encourages position building despite acknowledging interim volatility. A bearish headline shields analysts from angry clients if gold rallies, while a bullish $4,000 call puts their credibility squarely on the line. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and check our new Numismatics handbook. Most stackers want to get active, but swapping their metals for dollars isn't an option. There's plenty of opportunities in the overlooked numismatics world. Mastering U.S. coins, key dates, and errors pays off by multiplying your ounces and capitalizing where others aren't paying attention.
Well, I don't think they've ever really been a frothy top. I mean, there was a very brief moment when you could say that silver was a frothy top. Got up to what, sort of 37-ish, something like that. I mean, but really the reaction has been very, very minor from that frothy top. And the same with gold. I mean, gold sort of spiked up early one morning to 3,500, but it's just been moving sideways. And in these, as I was saying earlier, in these very quiet trading conditions, you would expect it to drift lower. I mean, I talk, if you like, as an ex-stockbroker, and I knew that in the case of any stock, and it's the same has got to be true of commodities, in the absence of buyers, prices go down. Now, here we are with gold, close to all-time highs. You've got no interest in the market. I mean, really very little in retail interest, that is for sure, because everybody's just out there enjoying the weather. Or, and this is what I found as a stockbroker in the UK, I mean, it was so frustrating, the summer months, because there was I on the floor of the stock exchange or in my office, trying to contact clients to find that my competitors had taken them out to Ascot, Henley, all the sporting facilities. I couldn't get onto anyone and get them to deal because they were already being, wined and dined by my competitors. So it's the same thing now. Nobody's interested. And you would think gold and silver would drift off, but no, they're not. And I think part of the reason is the weakness in the dollar. I think you've got to look at the dollar from the foreigner's point of view, always. They own, in terms of dollars and underlying financial assets, including about I suppose 7.5 to 8, or no, it's about 7 trillion of bank deposits, figure like that. Total is just under 40 trillion, of which I think about 14.5 is in equities. I mean, this is, this is a lot of stuff to be sitting on when the dollar's going down. And the dollar from, President Trump's, if you like, Liberation Day on April the 2nd, dollar's lost well over 10%. So where have you made up the currency loss on your underlying investments? Well, the answer is you basically haven't. You might have done a little bit, I suppose, if you'd sort of continued to invest in NASDAQ type stocks, the Magnificent Seven, because they've performed reasonably well. But you're buying into hot air. I mean, come on. It's, the idea that these stocks are value, if you like, that's just nonsense. If I was a foreigner, I would be, I'd really be reducing my positions, particularly when you get President Trump turning around and saying, the dollar should be lower. Okay, well, if it's going to go lower, that's not going to do me any good. And also President Trump turning around and slagging off Jay Powell. I mean, you begin to think, well, who's running things here? Right? Slagging off Jay Powell is actually a very bad thing to do. I'm not saying that I think Jay Powell is necessarily the most wonderful human on the planet. But, if you want stability in a currency, the last thing you do is start slagging off the guy who's actually running the most important institution providing that stability. He's doing the job to the best of his ability. And I would say he's actually been doing quite a good job, given if you like, the misconceptions that are around, Fed economists, because he's got to reflect the consensus, I guess. But I think he has actually been doing quite a good job. And to have a president turning around and saying, I'm going to sack this man as soon as I can, and all the rest of it. If I'm a foreigner owning dollars, I don't think I want to own dollars anymore. And the point is, there's 40 trillion of these dollars held by foreigners like me. Why hold them? And particularly, I mean, if you're, let's say, a trading business as opposed to an investor, you hold dollars for international liquidity. I mean, you've got to go out and you've got to buy commodities and all the rest of it, and you get payments, and you're going to end up with some liquidity. You've got to have liquidity. But now that the global economy is turning down, and even though governments aren't admitting it, you probably see it in your own trade, seeing what's going on with shipping and all the rest of it. You got too many dollars. Sell them.
What do you think of Holter's take? Do you agree with him? Are you buying more gold and silver at these prices? Or on the contrary, are you selling like most other retails? Post your honest opinion in the comments section down below and share your gold and silver price predictions with the Stacker community. Now, check out this next video right here because it's the perfect follow-up for you. I'll see you on the other side.